Well, we saw the Australian economy contracted by 7% in the June quarter. That was surprisingly close to our expectations. In fact, through all of last week, we're expecting 7%, but when we saw some stronger numbers on construction and on business investment, we shaved it back to 6%, and that was pretty much where the market saw things as well. So the number didn't come as much of a surprise to the markets, but of course it does have incredible historical significance. The biggest quarterly fall we've seen for the Australian economy was in 1974, when we saw a 2 percentage point fall. So this is just quite extraordinary. However, when we look across the world, Australia hasn't done too badly. So for the June quarter, the UK was more than a 20% contraction, the US was a little less than 10, and Europe was a little more than 10. So we're not standing too badly in that international comparison. And of course, the reason behind this collapse has been the impact of government policies to deal with the coronavirus. Those policies have been broadly affecting consumption. So we saw a 12.1% contraction in consumer spending, and that represented 98% of the overall contraction in the economy. We saw things like transport services down 88%, accommodation down 77%, catering down 55%, and health down 20%. So right across the board, we saw extraordinary weaknesses in consumption, with the exception of some household goods, which were benefiting from government payments. Indeed, disposable income was up by 2.2%, despite a 2.5% fall in wages. So wages down 2.5% sounds a lot, but hours worked were down by more than 9%. So normally you would expect that wages would fall in line with hours worked, but because of the boost that the JobKeeper has given to workers, many workers still receiving their wages despite working few hours, we've seen that distortion. So what does that mean? That's meant that the savings rate, with this huge fall in spending and an actual lift in incomes, the savings rate is lifted to nearly 20% from 6% in the last quarter. And that, of course, has meant that household balance sheets are actually in better shape now than they were going into this June quarter. Other components of spending were very weak, but nothing like the spectacular consumption story. So business investment down 3.6%, including a 6.7% fall in equipment investment, residential housing investment down by more than 6%, and real estate services down by nearly 20%. Whereas with consumption, we can expect the big hit to have occurred in the June quarter. The lagged effect of these recessionary conditions is likely to last much longer in that business investment and residential construction sectors. So what does it mean for the future? Clearly, we won't see another collapse in consumer spending in the way we saw in the June quarter going forward. But of course, we have seen this movement to stage 4 restrictions in Victoria. Our general feeling is that in the month of June, we did see a lift in hours worked, up about 4% based upon the labour market surveys, indicating that there was some momentum coming into July and August outside Victoria. And we're expecting that that momentum will continue through the rest of the September quarter and into the December quarter. Bear in mind that our forecasts are based upon Victoria moving from a stage 4 through to a stage 2 during the December quarter, and major outbreaks, second waves, not occurring in the other states. So with that in mind, with a big negative coming for the Victorian economy in the September quarter as they move from stage 2 down to stage 4, we're expecting that growth in the September quarter will be broadly flat. But in the December quarter, with Victoria turning around, and we expect about a 6% lift in Victoria's growth in the December quarter, with the other states demonstrating ongoing strength, then we expect to see growth in the final quarter of more than 2.5%. Of course, the big question is, what about the fact that in the December quarter, the government will be scaling back its very, very important support packages. Well, for one point, I think that the JobKeeper numbers that the government expects to be scaling back will be indeed nowhere near as large as the government expects. So I think JobKeeper support will still be an important factor in the December quarter. But also bear in mind the improvement in those household balance sheets, that lift to almost 20% in the savings rate. And we're seeing that in bank deposit growth, and we're also seeing strong bank deposit growth in the business sector as well. So all that money that went into the economy, the 60 billion in the June quarter, and we're expecting more than 100 billion in the September quarter, is still in the economy. And of course that will mean that the business and the household sectors will be in better shape to deal with the slowdown in the payments that we're expecting to come. So overall, a very, very devastating but not unexpected collapse in the June quarter, totally dominated by the consumer. A flat quarter expected in the September quarter, but a solid recovery coming in the December quarter as we see reopening right across the board. Thank you very much.